So to kick off, again, just recap, my name is Stephen Nolan, Managing Director of the UN-convened Financial Centres for Sustainability. I'm also fortunate enough to be the chair of this year's fourth Climate Finance Week. Across the week, so far there have been over 6 million social media impressions around Climate Finance Week, and several thousand people have also attended virtually the sessions, which is just awesome. And I want to thank my colleague Catherine for delivering that. But we're second last day, so we still have a day and a half left. So let's see what happens by the end of this week. But there are super statistics to go through. We have a special session now, and I'm delighted to be joined for this session by Jim Barry. The session itself is focused on finance and the transition. And before I get into asking a few questions to Jim, I just want to give a bit of background to Jim. I've known Jim for probably 15 years at this point. We have been around the world together at certain points, and we had a great dinner years ago in Washington, D.C. With the leadership there, and a super evening. But Jim is today the Managing Director and Chief Investment Officer of Blackrock Alternatives Investors, or BAI. BAI currently manages around just over $300 billion in total assets and climate commitments, with a team of over 1,100 people. So that's just staggering. And Jim, based here in Ireland, a Cork man. It's great to have you with us today, Jim. And within Jim's role as Chief Investment Officer, he also has accountability for all investment activities across the platform, which includes real estate, infrastructure, hedge funds, private equity and credit. And we're going to look at all those topics today in terms of finance and the transition and their role within. As CIO, Jim also oversees 4 strategic business pillars within BAI that focus on investment performance and process. And one of them is the implementation of a fully integrated ESG investing strategy and framework, which leads us to today's discussion. Jim is also a good friend and a mentor of mine. So Jim, I'm delighted that you've been able to join us today.
I'm delighted to be here too, Stephen. We'll try and get those impressions up, as they say,
yes.
At the back of this.
Single-handedly, we're looking at another million with yourself,
exactly.
Jim.
And I'm really glad you got out the fact that I'm from Cork, because I keep having to get that out with international people so they don't confuse me for someone from Dublin.
I know, Jim, it's important that somebody else says it, right?
Yeah, exactly.
And every road leads to Cork, and I know you came up from Cork last night, so we're delighted you're here with us in AIB studio in Dublin, so thank you very much. I suppose, Jim, you know, when we talk about Blackrock and it's this mega business, one of the biggest in the world in terms of asset management. And I was fortunate enough to see Mr. Fink, Larry Fink, speak at a G20 event in Venice a few months ago. Just the leadership that has been shown on this agenda. But, you know, you work for the largest asset manager in the world. You're Irish. There's an Irish team here as well that works for you on your agenda. But before we get into specifics of what you do in terms of your day job, in general, how is Blackrock looking at the ESG agenda, please, Jim?
So, look, it's a great question. I think to understand Blackrock, you have to understand it's a fiduciary. Yep. We're not a principal investor. We manage our clients' funds. And I think that has fundamentally shaped Larry Fink, who's Chairman and Chief Executive, and the firm's view around climate risk. In other words, it is a risk. Yep. This is something that is happening, that the world has to deal with. We have an embedded cost to this already, and it's going to be much more substantial and multiples of any cost of transition if we don't deal with it. And I think that what Blackrock has decided to do under Larry's leadership is to basically lead our clients on this journey. But it's truly from a fiduciary perspective. It's from a perspective of this is a risk one has to manage. There will be opportunities too as we transition, but fundamentally it's risk.
And Jim, you said a very good point there. If we don't deal with it, it'll be multiples of the cost of transition we'll end up actually paying, and I'm kind of paraphrasing that a bit, but that's the point I think you were making. So if we then get into your day job, you know, you have investment oversight of over, you know, $3 billion. Even saying that out loud, it's just staggering, right? In alternatives, and you have a lot of private market assets within that. We mentioned earlier on, there's infrastructure, there's credit, and so on and so forth. How will those different segments play into the transition, please, Jim?
Well, look, I think it's a great question, because we clearly have the liquid markets, listed companies, and both equity and debt, and we've got the banking system. But I think what you've seen, particularly over the last 10 to 15 years, is institutional capital allocating more and more to private markets. So those categories you mentioned, as you say, we've over 300 billion across credit, private equity, infrastructure, and real estate. And what clients are looking to do is get at different types of opportunity. As banks have pulled back capacity, there's great lending opportunities, particularly in an area like infrastructure, which I know intimately well. But also, I think that it also allows clients go after certain niches and certain segments in the private space that don't necessarily get in the public arena. And certainly as you think about everything we need to do, whether it's infrastructure build out, whether it's new technologies, it plays into infrastructure equity, infrastructure debt, plays into real estate as we need to adapt buildings to get more out of every unit of energy, greater efficiency. It plays into credit more generally, it plays into growth equity. These are all dynamics. We just launched a partnership with Temasek out of Singapore to specifically address decarbonization technologies, new business models with growth equity. So that's what private markets can do.
And Temasek in Singapore, what a phenomenal firm itself, and not a firm actually in terms of sovereign state there. But Jim, if I can move just within that, because you mentioned clients a moment ago, can we maybe unpack that a little bit? Where are the clients on this, Jim? And I suppose you've been at this for a while. You would have been one of the pioneers in renewable energy infrastructure here in Ireland, but from Ireland with a global portfolio. And that was hugely successful. So I suppose, where are your clients now, but what have you seen as the evolution, maybe over the last 3-4 years, Jim, if you don't mind?
Well, let me give you the 10-year perspective, because it was in 2011 when NTR and Blackrock came together to set up the renewable power equity business we have. I would say, that first fund, about $600 million, 40 institutions. If 5 of them had sustainability or climate on their agenda, it was a lot.
Yeah.
Okay, fast forward to sort of the 13 to 15 period when you raised a second fund of 1.6 billion. There, I would say most of the institutions would have had sustainability, ESG, at least as a tick the box item, without necessarily driving the agenda. But when we went to market in 19 with the third fund, hoping to raise somewhere around $2.5–3 billion on the back of a good, strong track record, we had good momentum this time last year, maybe last summer, tracking to that $2.5–3 billion. We closed in March at $4.8 billion.
Wow.
So what you've seen is this dramatic shift in client mindset around allocating to climate in particular. Sustainability generally, ESG as a set of criteria, but particularly to climate. And I think we're seeing that right across the board. Not all institutions are born equal, so the pension funds and insurance companies in somewhere like Europe are going to be much more attuned than, say, a pension fund in an oil-producing state in the United States. Asians and Canadians maybe somewhere in the middle. But there is a general shift. It's very material. And I think what's happening is that it's not just that capital is going to these areas around, kind of building new assets, for want of a better description, for transition, but it's also capital coming away from the fossil world.
Yeah.
And I think that has its own implications and challenges as well. But certainly capital is moving, and it's moving with real momentum, and it's unstoppable.
So capital moving, real momentum, unstoppable. It's just a fantastic soundbite coming from a leader.
I'm conscious of your impression.
Yeah, no, that's going to be the bumper sticker now. But coming from you're a leader in this space, a global leader. Who just happens to be from Ireland. I'm going to get Corkin again. But you are a global leader in this space. And so for you to kind of have that statement, but as you said, a decade of being at that coalface, maybe unfortunately use the word, but at that coalface in terms of watching that growth. But if you can maybe look at risk for a moment, Jim, because you said there's different regions have got different appetite. How are you addressing that, Jim, if you don't mind me asking?
So one has to understand that institutional capital is not really looking for risk, okay? And when it takes risk, it wants to be paid for it. So it's not by accident most institutions have bonds as the ballast in their portfolio, investment grade bonds. And so as we look to the challenge of investing for transition, we've got to be very thoughtful about the risk that's been taken on. And so what I would say to you, an area like, kind of with proven technologies like wind or solar, renewable power generation is something that's understood, right? And we have vast quantities of capital, both equity and debt, flowing into that space, both in the public markets and particularly in the private markets. But as we look to new areas, we look at things like hydrogen, we look at the carbon capture and sequestration as another example. We're looking at sort of new business models, new grids, new systems to manage all of that. That's a different kind of risk. And the challenge with that is not just the cost of capital for higher risk is higher, no surprise there, but the quantum of capital available drops off dramatically. Yeah. And so as policymakers, one's going to have to be really thoughtful as to how one addresses specific risks, particularly if you want to get, say, large-scale deployment as hydrogen to get at some more difficult to convert sectors, then you're going to have to think about how you shape it. Emerging markets, another area that's going to have to be dealt with.
And you know, Jim, it's been over the course of the week, there's a lot has been talked about innovation. And I think innovation is now a very much misused word because it's become so broad. But I suppose within this space, you're right, this is the role of the policymakers to be, you know, supporting the research, that type of activity that's going on. And I see during the course of this week, I think there was an announcement out of the US that there's going to be a significant increase in the billions in the research agenda around clean energy, which is super. And again, at the event that I was at with Mr. Fink in July in Venice, it was interesting that DARPA, the military research institution in the US, was in the tens and tens of billions. I think it was on 70, 80 billion of research per annum. Whereas at that point, clean energy research in the States was at a few billion. And so they're now really under the Biden administration trying to kind of jump at that. And Jim, I'm going to get to the emerging markets in a moment because I'm going to pick up on that. But again, US, the last 10 months in the Biden administration, what are you seeing there in terms of, you talked about momentum a minute ago?
So look, well, I touched on a few things there.
Yep.
The one thing just on innovation, right? I mean, so as an investor, you know, kind of more innovation means more risk.
Yes.
Okay. And so capital is going to be very pedantic in how it thinks about what it gets exposed to. And that's why, particularly in the early stages, you need governments involved. The other key issue with the innovations and new technologies, new business models required, is we have to do this in like 10, 20 years. And so everyone gets the scale of the transition now, I would say to you. Most corporations have woken up to that. But what they haven't woken up to is the pace dimension of it. And you know, if you look at where we've got to with renewables over the course of the last 40 years, that's fantastic, but it's taken 40 years. Yeah. Okay, and we needed, you know, Chinese, German, Spanish intervention 15 years ago, you know, to drive scale deployment that ultimately drove costs down. Where are we going to get that here in a time frame that's like tomorrow? And that's where the only ones who can make that happen are governments, essentially. And so, you know, that scale, not just with that early stage technology investment like the DARPA would cover in the sort of defense space, or NASA in the space race. It's more a case of, you know, kind of more broadly in obviously renewables, but also efficiency of use, but also business models, software. There's so many dimensions to this that need investment. But it's not just new technology or new innovations, it's scaling them. And I think that's the one that's critical. Private sector capital can play a role, but really it needs to be given a context, a much more stable and sort of, you know, kind of moderated risk context than would normally be available. And if you wanted to scale in the short term, that's absolutely critical, because without that, it'll happen very slowly and insufficiently quickly for the scale of the challenge we have.
And Jim, I may be aligning two things incorrectly. Are we seeing part of that challenge play out now in the energy prices in the last few weeks, or is that
it's a slightly different thing, okay? And I'll come back to the US as well, because I think that's also important. But specifically on the current energy crisis, what policymakers are going to have to wake up to, and even the capital is going to have to wake up to our clients, it's not black and white, green and brown, you know what I mean, good and bad. It is a spectrum of gray.
Yes.
And in making this transition, we can't just stop using fossil fuels tomorrow, okay? Yes. Because, you know, government's validity and credibility and legitimacy is tied to obviously food and water availability for people, but also energy, both what I would say fairly or cheaply priced energy and guarantee security of supply. And I think that there's real risk to both as we transition. And I think what you're seeing in the context of the current gas price phenomenon in particularly Northwestern Europe, but we have this playing out in other areas, coal in China, and obviously gas in Asia as well, is we haven't been investing in infrastructure adequately. Gas has a key transition role to play. And what we're seeing is, you know, kind of in effect, a lack of policy intervention, very much an open market approach to the gas and power markets, has left us short of critical capacity as we've dealt with a long, cold winter, lower wind, Gazprom playing games, you know, you name it, all coming into a mix. And so there is a real sense of crisis that's reflected in pricing, that we could be short of gas and power this year. And if you look at Ireland, We're at the end of the gas pipelines. And so, this is part of the complexity policymakers are going to have to wrestle with. Going to the United States, because, kind of the elephant in the room is China and the United States and their ability to get on here and cooperate and coordinate around climate change. The Biden administration has very clearly nailed its colors to its mast, but there isn't cohesion in the US political system, in contrast to most Western and developed economy political systems around climate change. And that's a real challenge because really the United States will only be really committed when there's legislation to back up commitments made on the international stage. And so I think that's one of the big challenges for the world as we face into the next 20 years. But I would say private capital in the United States understands. I think the energy and power complex substantially stands because it's existential to the conventional industry's existence. And so, kind of boards and management teams are focused. I think any consumer business is absolutely focused. And so the world is moving on ahead of the politics. But I go back again, it really is going to need significant policy intervention ultimately to get the scale of transition we need.
So policy intervention, the scale that we need. And Jim, it's fascinating to hear your insight there to the States. Can I move maybe over to the emerging markets? You've mentioned emerging markets a few times. What's your perspective there on this agenda, please, Jim?
So again, and again, our firm and Larry Fink has a very clear view on this. The challenge with emerging markets is that there is a lot of risk. Yes. Okay, there's currency risk, there's rule of law risk, there's more regulatory uncertainty adding to risk, land right issues, a whole range of dynamics in emerging markets that add to risk. And so consequently, institutional capital is very wary as it deploys and exposes itself to emerging markets, typically in a very diversified basis, typically in a very liquid basis. So bonds of the country, maybe the equity markets. But at $150 billion a year of sort of investment, it's well short of at least $1 trillion a year that is estimated to be required to sort of get at the transition. Now, it's also an opportunity because kind of particularly renewable power, microgrids, the way we might deal with this can democratize energy and power in a way that mobile phones democratized communication. And so there's an opportunity here, but institutional capital won't do it without frameworks that allow the capital to be deployed safely. Trustees of a pension fund here in Ireland aren't going to deploy to sub-Saharan Africa unless there's much greater clarity around how the return can be safely made on that capital. So multilaterals have a clear role to play, both directly deploying capital, effectively taking capital from the developed world, deploying it in the emerging developing world, but also coming up with ways of ensuring risk or shaping risk in a way. We've just formed a partnership with both the German and French governments and a number of sort of social enterprise institutions, Japan as well, where we've created a structure for institutional capital where there's some catalytic capital, as we call it, about a $500 million fund where about 100 million of that is first loss capital,
yes.
Invested by these state institutions and some NGOs in a way that it'll make a higher return, but it's also there to provide a buffer and protection for the institutional capital. That's one micro example of trying to be innovative around addressing the issue. It has to be done on a much larger scale, and it can't be done again without, to my mind, very clear policy and multilateral involvement.
In a moment, we're going to go to our next session, which is about carbon pricing. But let's have one more question there, Jim, if I may, just informing our viewers there. Again, Mr. Fink in Venice earlier in the year was very much to your point about the multilateral development banks. And actually the exact same message you said there. And they also need policy guidance to, change their behaviour and then, as you said, scale up. And that's a great example of what you just mentioned. And obviously COP is going to be quite important because, again, these big policy discussions are happening under Mark Carney's leadership. The 3rd of November is the Private Finance Day. There's a lot happening there, risk management, mobilisation of capital, reporting and so on and so forth. That's going to be an important day. I suppose if we can bring it back home, Jim, to Ireland. Earlier on this week, Minister Donoghue launched Ireland's first national sustainable finance roadmap, 18 different actions, and the number one is the development of an international sustainable finance centre of excellence in Dublin in partnership with the UN. So very excited about that. How important, Jim, you know, a financial centre such as Ireland looking internally to finance our national decarbonisation, a role within Europe, but also within the emerging markets. A lot of actors here in Ireland, particularly renewables, have been working in these jurisdictions for a long time. How important is it that Ireland as a jurisdiction has a roadmap now and that it really accelerates the delivery of that, Jim, please?
So look, I would say to you, we've been talking policy throughout this discussion, and so to have clarity around that is absolutely critical. But I do think Ireland, you know, and this is one of the areas that Ireland can definitely punch above its weight. Yeah. Our early engagement in renewable power back in the late 90s into 2000s, lots of entrepreneurial companies, you know, you find the Irish throughout the global industry now, and I think a lot is centred here in the country. I do think that, you know, we clearly also have established ourselves in the finance space, and for Blackrock, Ireland is really important. We've got great clients here, but we also base a substantial number of our funds here in the various structures government policy has allowed. And so I do think being creative around enabling, you know, kind of the development of new models of finance, making it easier for institutional capital to deploy into some of these opportunities where it's emerging market or not. I think that's an area for Ireland to play, and I think that we do have, as I say, some underlying experiences, capabilities, makes us very credible in the space. Which yourself is no less an example.
Look, Jim, I'm from Dublin, right?
Yeah.
So everybody can't be perfect. Look, Jim Barry, thank you very much. And I do apologise to our viewers for going a little bit late into the carbon market section. But look, it's rare that we have a global leader in the financial services space able to join us in studio such as Jim. So delighted that Jim has joined us. In a moment, we're going to go to our next session, which is Carbon Markets, an Evolving Landscape, a private sector briefing. And we're joined by Bo Jin, who is with Bloomberg New Energy Finance and their lead on carbon markets. So in a moment, we'll be there. Just give us 1 minute, please.